Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Peter St Onge. He is a Ph.D. economist and professor, and he posts his short videos on Twitter and YouTube. Peter, welcome to Wall Street Silver.
Well, it's great to be here. Thanks.
Yeah, it's an absolute pleasure having you on. Peter, there's been a lot of talk about a gold-backed digital currency emerging from a Texas legislator. Will this ever be implemented, or would the Fed rather just have a CBDC not backed by gold?
Yeah, I think definitely they would rather just have a clean CBDC from their perspective, meaning a CBDC that they can do anything they want with, like Play-Doh. They may welcome the Texas bill because maybe they figure, it's kind of a nice opportunity to try to pitch gold bugs on a government surveillance coin. I mean, for me, it's kind of a weird bill. Like it
Right.
takes the most beautiful thing in the world, which for me would be commodity backing of the dollar, and then it marries that to pretty much the ugliest thing on earth, which is a China style social credit coin that controls everybody and gives bureaucrats insight into every gun or every steak dinner that you have without bureaucrat permission. So I mean, personally, I prefer a lot of the other bills that are kind of floating up at the state level that seek to either have the state itself issue a commodity backed currency. This is actually in the Constitution to begin with. So the Constitution does not actually delegate the federal government the ability to print paper money. What it does do, though, is that it tells states that they can only make gold or silver into money or into legal tender, which implies that actually, strictly speaking, according to the Constitution, a individual state should be forbidding you to use fiat paper dollars. Instead, they can only designate something that's gold and silver as legal tender.
Peter, what do you think about the other commodity-based currencies? A lot of people are talking about the BRICS, and like, how would that work? Is that feasible, or is that just a bunch of hot air?
To me, it's really interesting. On the one hand, BRICS is kind of a motley crew of, from a monetary perspective, pretty disreputable countries, right? So you've got Brazil in there, who of course had hyperinflation back in the 70s and 80s. Russia has had essentially a hyperinflation even more recently. So on the face of it, you wouldn't really expect these guys to be running a currency that could actually give the US dollar a run for their money. On the other hand, what to me is fascinating is the fact that there is this massive opportunity, this massive strategic kill shot lying out there, out in the open, which is backing your currency with gold or silver, right? Any country that does that is going to have the reserve currency if the world actually believes, right, that they can go down, they can send their fiat of whatever currency it is, and that they'll actually get gold back, right? All you have to do is convince the market that you're actually willing to do that, and it'll take some time. It might take months, might even take a couple of years.
Mm-hmm.
But if you did that, you would instantly knock out the dollar. And we know this because Switzerland, until about 1990, Switzerland had partial gold backing. They had nowhere near full gold backing. It was just almost a token little amount. And yet the Swiss franc punched way above its weight worldwide, right? You would go anywhere in the world and you would look at these exchange rates and you would see US dollar, British pound, French franc, and then all of a sudden you had this just weird little CHF thing, and you think, what the heck is that? Switzerland. Well, it's got like, I mean, at the time it had 4.5 million people. No, the reason was because there was just the slightest dash of gold in that currency. So anybody who wants to take over the currency game, all you've got to do is back it with gold. Now, what to me is kind of a fascinating question is, what if BRICS, and BRICS is really kind of a China-led operation here, right? Literally, you've got Brazil, Russia, India, China, South Africa. They've got new countries coming in like Saudi Arabia, but really China is holding the whole thing together. China greases the wheels. They have development banks, which are sort of like bribes to stay in the system and all this. And if China, one of their main goals in life is to bring down the American empire, to get America out of the way, because they feel like if they can do that, the world belongs to them, which I think is probably true.
Right.
So the question at that point is, China can implement a BRICS currency, which is gold backed. it could be completely separate from their own currencies, so they don't have to risk, exports getting expensive and all the standard reasons why a country might not want to do that. So China could do that. They have the means to do that. They have the motive to do that. That to me is kind of the fascinating potential destiny for the dollar here.
So, Peter, talk to us about where we are at the current economic cycle. Like looking at this chart, how do you interpret what the Fed is actually saying versus what the market actually has priced in?
Yeah, so the Fed, of course, wants to signal all clear that nothing is going to change. They're open about this. That's forward guidance. They gaslight for a living, and the market is actually paid to get things right, not to deceive. And here, what the market is saying is that they think that the economy is going to run into a really rough patch. We're not going to get a soft landing. That means that rates are going to have to come down because the Fed is going to panic, and so they're going to have to try to raise liquidity again. If that happens, then we are looking at a massive leg up for hard assets, particularly for gold, probably something comparable to what we saw last time around, because what it's saying at that point is that this sort of soft landing scenario where the Fed just very calmly cuts off the money spigots and we return to normal. What that would be saying is no, that's not going to happen. What we're looking at here is a zigzag, maybe more like the 1970s, where the Fed kind of tried to half kill inflation, wounded it, and made it stronger. And that started to raise the prospect that we're in for a long spell of inflation here.
Peter, before we started recording, you said the Fed is hiding inflation. Can you explain what's happening there with our audience?
Yeah, the Fed is using two mechanisms to essentially put money on ice and park it in the Fed itself, so that gives them the ability to sort of print money and give it to their friends or use it for whatever purposes they like, to subsidize government spending, for example. But they know that when they do that, it's going to create a lot of inflation across the economy, and then voters are going to get upset. And of course, if voters are upset, then that's dangerous for the Fed. So what they do is that they essentially print up all this money, and then they use either the paying banks interest on their reserves, or they use the reverse repo mechanism to essentially bring all of that money back under their control so that it's not floating around in the economy. So here we've got a chart. These are reverse repos, and you can see that they were kind of bumping along for years and years, where the Fed was using them for various, sort of smoothing things out in the market. And then in late 2019, they had a little crisis in them, which gave them a big stir. And now we're seeing they have absolutely exploded, right? So as the Fed has created all of this money, right, since COVID began, the amount of U.S. currencies increased by about 40%, right? So that means that round about $1 out of $3, was created in additional money. And so they've had to soak it all up. And, they've done something similar with bank reserves as well. So you put those together, and the Fed is paying enormous sums, at least $275 billion a year just to the banks. They're paying this so that they will park all of that new money that the Fed created in order to stop it from bleeding into inflation. But of course, the problem there is that unless you're willing to pay $275 billion for eternity, you have not actually made the inflation go away. All you've done is keep it out of the headlines and hidden it. So the American people are now effectively, their dollars are being diluted in order to print fresh new dollars to hide the dollars that were already printed.
Wow.
It is just absolutely irresponsible.
So what's next? What happens after?
With these, what they tried to do in 2008, they did something similar. That's when they sort of hit on the idea of paying banks to hide their inflation. And the way that they tried to solve that was to by slowly sort of, letting the air stream out. And therefore, all of the inflation that comes out of that, you can kind of spread it over here and there. It can kind of blend in with the other inflation. But that's actually where that 2019 situation comes out. So they were, trying to slowly run off the balance sheets and, sort of trying to reverse all of this new money that they created in 2008. And it turned out that it is very easy to add free money to an economy. It's very, very hard to take it away. It's like salting a meal. And so, once that 2019 thing hit, And I mean, that just hit completely out of the blue. Nobody was looking for it.
Right.
You know, it was one of those moments where it sent them in a panic. The entire world was like, wow, what the heck is happening? And the first thing you get is the Wall Street Journal explainer articles. And whenever you see those explainer articles, you know they really screwed something up because something just broke. That's a front page story and nobody knows what it was. We saw that in 2008. You probably remember, like early in the 2008 crisis, there were all these explainers all over the place, even the Wall Street Journal, which, you know, in theory, journal readers know what they're doing. They had all these explainers like, what is an MBS? What is a CDS? Because nobody is looking at this stuff. Nobody knows what the ghosts are in the machine. And there is so much debt. There's far more debt than there was in 2008. There's so much debt now. They have so many of these little, you know, clever by half, clever by 3 times mechanisms that they use. Like, okay, we're going to print the money. We're going to hand it to this guy for the collateral. And then he's going to park it over here. And then we're going to, I mean, come on, guys. You don't even know what you're doing in normal times. The Fed does not even realize that printing money causes inflation. And they're sitting here with these 12-step Rube Goldberg machines. So that's the concern at this point. What's going to break? And the answer is nobody knows.
So, Peter, a lot of people are predicting the Fed will start cutting rates, but when they do start cutting rates, what happens to all these reverse repos? And if people haven't, like, if they haven't actually solved inflation, but are still forced to cut rates, what's the outcome?
Yeah, a lot of that has to do with why they start cutting rates. So normally, if rates are coming back down, then you would expect some of this to reverse. The thing is, reverse repos have a second function, which is that for hedge funds or other so-called shadow banks, they can park money at the Fed, knowing that the Fed cannot go bust. Now, the Fed is bust in a sense, but of course, the Fed has an unlimited money printer. So unlike a commercial bank, the Fed is never going to be legally bankrupt. And so that means that the Fed is sort of a shelter in the storm. And so if rates are coming down because the Fed panicked, because it thinks that it broke the economy, then it can actually backfire and you can get even more capital going in there. The Fed, is aware of this, has its treasury. And so one of the things that they're trying to do now is to spread these bailout guarantees, these FDIC. They're trying to spread that to all bank accounts, which, asymptotically moves us towards a country where, really no bank would care who they lend to because it's not their loan anymore, which is kind of a shocking reality. Why not just, the next homeless guy walks in the door, just, you can fill up your entire loan quota for the year and just, as long as you're pretty sure he'll pay you for a couple of weeks until you have to hand over the bad debt. It's an insane world.
So Peter, when governments are actually forced to choose between saving the economy and actually saving the dollar, and people know that you can't actually do both, historically, which way do governments lean to?
Yeah, so I'm an Austrian economist, which means that we don't look at it from the perspective of God like a central planner would. We look at it from the perspective of the individual in question. And so in this case, the question is, what are the Federal Reserve's goals in life? And their number one goal is to serve the masters who can make them dance, right? Who can take away their independence, who can put new mandates on, who can appoint people. And that is, in practice, the government, the administration, and the Congress. So at that point, it then collapses into what are the goals of the administration? Well, they're going to try to get away with as much inflation as possible, but that's more, they want to look busy, so the boss doesn't catch them. Their real goal is to take as much resources as possible for government spending, take as much control, take as much of the accumulated wealth of the American people. So in light of that, austerity? Absolutely not. That's not going to happen until, the Roman Empire stage of they're going to try to, do a mixture. They'll squeeze the private economy, which is what they've been doing over the past couple of years. Right. And then they'll mix that with enough inflation as they can get away with. There's already this kind of PR campaign running around the major newspapers talking about how maybe 3% inflation is good after all. you've got these PhDs, these just payola cronies who go out and write up these sophisticated papers full of math arguing that 3%. All right, all they're saying is, maybe we should steal more from you. If they think the public will accept 3% because they can bamboozle them, then they'll do 3.49. They'll do all of it that they can get away with, and whatever they can't get with that, they're going to crash the economy instead as the next best option. And what they absolutely will not do is stand up to their masters.
So Peter, before you go, I just wanted to say we've been sharing your short videos on our channel lately, and we want to thank you a lot. Like, thank you so much for letting us share this amazing content with our audience. Everyone in our whole channel really likes the explainer videos that you're doing. So thank you so much. Like, we really appreciate you, Peter.
Yeah, thank you for, posting them. You guys have just been incredible, really reached a new audience, and, your audience is really well informed, very passionate about these topics. It's been an absolute honor. I said teach MBA. I used to do these things before class, so the hungover students would show up on time. My wife was like, "No, post it. People care." And I was like,
That's awesome.
It's gold. It's inflation. Who cares about this?" But no, seriously, thank you guys so much.
Yeah, no, huge pleasure. And hopefully we can, obviously you're going to be doing your short videos on Wall Street Silver, but if we can have an interview like this in the next 2-3 months on a longer format, that'd be awesome to have you back.
Absolutely. Yep. Would love to come back.
All right. Take care.